Good morning, everyone. I hope you all are having a good day. Today, we'll be discussing the next chapter. So, chapter 3 from the book, from the Advanced Accounting book. This will probably be a series where I'll be discussing a lot more questions from a lot more different chapters of the book. Speaking about the book, this is the book that I've been using. So, I haven't showed you in the first video, but this is the book that I use. So, it's called Advanced Accounting. 13th edition, global edition. These people made the book. It's a Pearson book. I'm just going to say that. So, yeah, I've taken two questions from chapter 3 and we're going to be discussing them. Chapter 3 is all about consolidated financial statements, and it means that if you have financial statements of the parent company and the subsidiary company, consolidated means to combine those two into one, what we call consolidated financial statements. So let's jump right into it. Question one. A parent company called Wins, they acquired 70% of MAT with a cost of this. MAT, the subsidiary, have net assets of this, net income of this, and dividend of this. Fair values of MAT net assets were equal to the book value. Now, what I first would do in this question is to first pay attention to the last sentence here. So fair value equals to book value. This is good for us because we don't have to perform extra calculations to calculate the difference in fair values and book values of the net assets. Otherwise, if the values are different, we should perform more calculations, in which we as accounting students may feel uh, troubled. You know what I mean. So it's good that the case doesn't provide the fact that the fair values were equal to the book value. Otherwise, we should do like more calculations. Anyway, this is how I solved the question. So let's start with providing the information from the case. So this is the year, 70% of ownership, the cost, net assets, net income, and dividend. Fair value equals to book value. That's good. So what I would first do, oh yeah, I haven't discussed the requirements. So we need to calculate goodwill and non-controlling interest, just so you know. You can see here the question here. Right, so first we want to calculate the goodwill, right? So in the previous video, we have discussed that goodwill is what we basically pay and what we subtract what we get, or the other way around actually. So, oh wait, no, I was correct. So it's the amount that we pay versus the amount that we get. But then in the case of what was it again? Wins Incorporated, we cannot use 1.4 million to calculate goodwill, because the thing about goodwill is if you want to calculate goodwill, you have to use the full amount. So you cannot use the 0.7 amount. You cannot use the 70% amount. You have to find what would be the cost if the acquired, the ownership of Matt Inc. is not 70% but 100. So that's why I performed this calculation. Cross multiplication, if you still remember the materials in middle school or high school, you can basically find the 100% amount by doing this. So you multiply 70% by x, 1.4 million by 100%, and then you just kind of have to figure out what x is, and that should result in 2 million. Or in other words, you want to divide 1.4 million by 70%, and you should get the same amount as well. So that's how I find the full amount of investment. So here I put in 100% investment of 2 million. So we're going to be comparing this with the net assets that we get, which is this amount, 1.5 million. So we subtract 2 million from 1.5 and we should get 500. That should be the goodwill. And this should be I'm actually also bridging to the question number 2, but this is how I like to record it. So we first have net assets, 1.5, goodwill of 500. So that makes it 2 million, the full amount. And to compensate that in the credit side, we have investment in MAT, 1.4 we've taken from this, and 600 belongs to non-controlling interest. Now, what is a non-controlling interest? You might say non-controlling interest means that is the ownership is the non-controlling interests are the owners who owns less than 50%, because in accounting if we own more than 50% of the company, in this case, the parent company does own, 70%, so it's more than 50, we basically have control of the company. We don't own the full amount of the company in a way that we own 100%, but we have the control of the company because we own more than half of it. And so that's a controlling entity. Non-controlling entity is basically the opposite. And so in accounting, we use this account called non-controlling interest. And it's basically the rest of the amount from the 2 million from the cost that the, what was it again? Wins Incorporated acquire, pay, I mean. So yeah, 1.4 and 600. But then this is not the end, because in the case, they also provided the net income and dividend, which we should take into account into updating these two accounts as well. So I did calculations for both of them, even though we only need to do the ones for the non-controlling interest. But we can start with the investment in math account. So this is the initial investment, 1.4. And we assign 70% of both net income and dividend into the account. You see what I mean? So 420 is 70%. And 210 is also 70%. The reason why dividends should subtract the initial investment account is because when the subsidiary is paying dividend to us as the parent, the subsidiary, in a way, they converted their equity into cash so that they can pay us. So that process should reduce the equity count. So that's why this reduces initial investment instead of adding them. And if we sum it up, we should get 1,610,000. And we can do the same for the non-controlling interest account. So assigning 30%, because the non-controlling interest is out of 30% of income and dividend paid. And we do the same calculations and update the non-controlling interest account. And the end result should be 690. So that's for question number 1. I hope I did everything correct. Just let me know if I did anything wrong. Question number 2. We're moving on to the last question. So SUSEC is an 80% owned subsidiary of Yum. So what this basically means, you need to understand this because this is important. Yum is the parent because SUSEC is owned by Yum, right? So SUSEC is not the parent, but Yum is the parent. SUSEC is the subsidiary. Fair values of SUSEC's net assets were equal to the book value. So again, that's a good thing. Now, Yum has a separate net income before recognizing income from SUSEC. And it was this amount, 350, while SUSEC has a net income of this amount, 240. What it basically means that SUSEC's net income and Yum's net income were separated and was not consolidated yet. And so we, as the accountants, we should consolidate them, right? So we are first need to calculate income from SUSEC that should appear in the consolidated. So income from the subsidiary. So and calculate the controlling share of net income. Controlling is the Yum company because Yum owns more than 50%, 80% here. And so they are the controlling entity. So the controlling share of net income. We should calculate the aggregate amount of net income coming from SUSEC and the initial net income of Yum. Without further ado, I'm going to show you what I did in this question. It's fairly simple. So we have the ownership, we have the separate net income from Yum as the parent, and we have the income from SUSEC. Net assets, fair value equal to book value. So that's good. The first thing that we need to do to solve the first requirement is to calculate the income that we get from SUSEC. So SUSEC reported income of this amount. But then, since we only own 80%, we don't own SUSEC fully, we should only receive 80% of the income from SUSEC and not 100%. So we just take 80% from 240 and we should get 192 like this. And so that's for the first requirement. For the second requirement, we are needed to calculate the controlling share of net income, so the aggregate amount. So what you should do in this question is to basically add the income we get from SUSEC to the income that we have initially as the parent company. So initially they have an income of 350, and so you just basically add that with 192, and you should get this amount, 542. And so that should be your answer for both number 1 and number 2. And that concludes my video for today. I will be discussing more questions from more chapters in the future, but as for now, this is the questions I'm gonna be discussing for today. And yes, let me know if I did anything wrong. Um, and yeah, I guess I'll see you. I guess my bad. I guess I'll see you in the next video. Okay, bye bye.